Hello, everyone. Welcome to an Options Income Blueprint, Options Income Weekly Live on December 5th, 2022 at 11 a.m. Eastern with Michael Schulman. And my name's Emily Norris with Traders Reserve. Just to let you know, we are recording this session and we'll be posting it to the member website. We'll also be sending it out to you in your weekly newsletter today. If you have any questions, feel free to put those in the Q&A box. We'll get to those once Michael wraps up with his presentation. And our next live trading session is going to be tomorrow at 11 a.m. Eastern. With that, I'll let you take it away, Michael.
Thank you, Emily, and thank you, everybody, for joining me. Just to repeat what Emily said, we have a session tomorrow. Today, I want to talk about two of the core stocks. I determined or recommended that these were core positions we would trade for a very, very, very long time. And that started back in the middle of 2021. But let's review. You can see we took a big loss on Citigroup, which is one of the things I wanted to talk about. But there were times to do that. There just really is. And that again, this position we were in for a very, very, very long time. And I don't mind staying in a position for years if we're throwing off cash, if we're profitable already, if the position is in the black, or if we're down. They're there to generate cash. And over time, of course, Citigroup is there's no worries about the company per se, but there were concerns, which I'll get into in detail, about what is the stock going to do for the next 6 or 12 months. And for those of you who are brand new, it's not the best way. This is your first live update. This is not the best way to introduce myself and the service, but it is, because losses are so rare. They need to be explained. They need to be transparent. And so I'm really glad I saw a bunch of new names that you're here today. You can see last week, was a cash-rich week. We did quite well, thank you. And in particular, the Williams-Sonoma trade, I thought was really cool. It was a monthly. The weeklies are liquid. Williams-Sonoma, probably top 3 of my retail picks. And part of it is a personal bias. They're a brilliantly merchandised and brilliantly managed company. And while you may be in other services and you may read materials and Seeking Alpha or somewhere else, and it's all numbers. Management matters. I mean, it really, really matters. And in retail, to quote Jim Cramer, I think it was his father, actually, no retailer has a right to live, as you can see with all the retailers that have shrunk or gone out of business or are knocking on that door, such as Bed Bath & Beyond. Retailers, you can always, even if Amazon went away, we'd be annoyed for 6 months. And then, okay, sure, fine. Why? We buy it somewhere else online. And so Williams-Sonoma, we opened with a very, very large amount of cash coming in. And the potential rate of return was huge because it was a monthly, but then we closed it. And so if you take a look up here, you can see the hit we took on Citigroup, but you can see because of all the cash coming in, we had negative cash flow. The first one this calendar year, I think it's the first, maybe the second, I apologize. And, but the bottom line was, this is the way you manage trades together. We don't have a portfolio, but you manage your trades. I manage the trades, you manage the trades, looking at the amount of cash coming in and so forth and so on. So Williams-Sonoma was opened and closed in a very short period of time, despite having a December 16th expiration date, because the rate of return was there. It was just, this was one point when we first sold it, and then we had a chance to make a lot of money when we closed it. And if you're brand new and you're unfamiliar, go to the website, take a look at the opening statement and the closing statement. If you hear any background noise, they're working around my office in another unit. Now, last week, Chairman Powell said what we already knew. The market popped, but then it paused the next day. And you have to get used to this if you're new to the market, and even if you're not new to the market. We're in our first interest rate driven, sustained bearish period of time since the 70s. And the bottom line is the market tanked because the jobs report, because they said, oh, that means the Fed is going to continue to is going to continue to do its thing and raise interest rates, and there's a sell-off in the bond market, and then it's stabilized. And I prefer to look at the economy and say we have to deal with short-term trading events in the market related to the bond market. And for those of you completely new, when interest rate concerns hit, positive or negative, issues, bond market moves, bonds hit equities. But what's interesting from last week is there were GDP revisions that were quite positive. The jobs report was extremely positive, but there's an asterisk next to that I'll go through in a minute. Supply chain was very positive because the rail strike was averted. And supply chain was negative, zero COVID policy in China. Well, let's go through these three for a second. The GDP revisions, the jobs report, I underestimated in my own head. And in my notes, I thought there'd be 175,000 and there were 270. And then I looked at the breakdown, and enormous amounts were either in direct government spending or indirect government spending. And that was healthcare, infrastructure, so forth and so on. And of course, it makes sense. The climate change bill and the stimulus and all the things that came out of Washington are now seeing, finally, it's the beginning of a new fiscal year, October 1st, you're beginning to see monies being made available, and that means jobs need to be created. And I think everybody was caught a little bit by surprise. But those are the kind of things that don't necessarily overheat an economy. So I don't think they're going to have an impact on the Fed. That's why I brought it up. The zero COVID policy in China, which is, someone wrote, I can't remember the fellow's name, but I agree, we're going to end up from China with COVID in name only, meaning they're going to say they have COVID lockdowns and restrictions, and they're going to slowly ease them as their healthcare system, which is very fragile, is able to handle things. If you're not aware, they only use domestically produced vaccines, which are very weak against the Omicron variant. A lot of people in China don't trust them. And they prioritized workers and younger people, not older people and the elderly are pretty much unvaccinated, which could cause tremendous strain on their healthcare systems. So they're in their protest, as you know. So the bottom line is it's going to morph over time into COVID in name only, but the consequences are already being felt, and it's an opportunity for us, which is why I'm dwelling on it. Exports from China to the United States were down 40%. And for the first time in memory, American imports from Europe surpassed American imports from China. And this ain't going to change. And direct investment, foreign direct investment, FDI, into China is basically ground to a halt. These are all investable opportunities for us. So when you invest, you need capital. So you need to free up capital if you think something's not going to work. And the reason is I see the stock is dead money. Famous last words, right? Watch it go up $10 tomorrow. It's dead money for good reasons, which is you have uncertainty, of course, around the banking sector because of interest rates. Previous logic and past is not prologue is when interest rates go up, banks make more money. And for regional banks in particular, that's true. But money center banks have investment banking operations, they have foreign exposure, they have trading desks, credit cards, the whole nine yards. Citi is, compared to the other large money center banks, which are Morgan Stanley, Bank of America, Goldman Sachs, JP Morgan, Chase, they have a larger exposure from a profit point of view to Europe. And Europe is really going to get whacked this winter because of what's going on in Ukraine. There'll be selective energy blackouts, that kind of thing. The other reason I closed it was going into a very uncertain year about interest rates. I wanted to, and mortgage rates, I wanted to get to a company that had a more balance. I wanted to get down to one bank. We may anecdotally trade other banks, meaning we'll trade them for a week or two or three. We may trade the KRE, which is the exchange traded fund for regional banks. But the one I want to stick with throughout the year is Bank of America. I've not been a customer for 30-something years. Largest retail bank in America, open position. We're underwater, but we generate a lot of cash every week or two. And has Merrill Lynch trading, not investment banking, has, especially in fixed income, has offset any weaknesses. And they have exposure, but not overly large exposure to the mortgage market. And let me conclude with Citigroup, because I've already done this for several people. If you continue to stay in the position, I have members in both Options Income Blueprint, Income Masters that never take a loss. They have enough capital. that they never take a loss, which is sort of what I do in my own portfolio. Unless something fundamentally changes with the company, bad, I'll close it. In this service, it's if something happens bad with the company, or Wall Street's metric of valuing the stock changes, or it's dead money because of trading biases, those reasons, then I'll close it. But there are people who don't want to. So if you have a question about where the stock is going and a look at the chains, send me an email. I won't give you a very specific recommendation, but I'll help guide you through the process of putting on your own trades. Let's go down. Let's turn it around. And this is another stock. If you just go and go, wait a minute, your 4 stocks are all underwater. Yeah, they're underwater, but these are core stocks. I told people I'm going to trade them for a very, very long time, and we will. So we've been trading Marvell for a very long time. It is the market leader in supplying chips to the cloud server and the auto industry, especially auto industrial markets into auto, its electric vehicles. And that's how the stock ran up when the EV thing became really hot because of administration policies and so forth and so on. It's also extremely diverse. It's rather large, and it's a many multi-billion-dollar company. It's very diversified. It even sells non-chips, other components. And yes, cloud server is declining. EV is exploding. EV has supply chain and factory issues and so forth and so on. But it's here, folks. It's no longer, the weird Tesla showroom in the shopping mall going, what is this car? And the latest earnings announcement validated its market leadership position. And it's really underwater. On the other hand, it throws off enormous amounts of cash. And this is the kind of story stock that I'm not going to close. I don't think it's dead money. It's traded down with chips. It's traded down with the market. It's traded down with the NASDAQ. And these are trading events. But for us, it's about cash. And more importantly, if you're new, relatively new, and you didn't get into March, but you got in June or July or whatever, the trades have been quite successful if you're doing the second leg of our rolled positions. Getting back to Marvell, the company, it was record revenue. It was up 27%. The EPS missed because of supply chain issue, in my opinion, because of supply chain issues. You can see both, that's not a typo, both data center, which is cloud servers, and the EV/automotive were both up 26%. And consumer revenue was down 2%. The reason the stock sold off was management forecast came in light. But the important number in tech, especially in chips, is the gross margin number. Gross margin is what a company uses to fund new development, stay ahead of its competitors, and to market itself, or in this case, you have salespeople. And those were very, very good. So the stock is down 50%. That's what I mean it's undervalued. It's completely oversold. And my estimate is selling at 19% forward earnings. And if you throw in the growth metrics for chips, for the NASDAQ, for the S&P 500, and for the company, that's a really low number, given that it's still going to have double-digit growth, meaning it had a lighter forecast, but it's still forecasting significant double-digit growth. And with double-digit growth, that forward earnings number should be over 30, maybe 35. So based on history, based on how it's done and so forth and so on. And for us, while we stay in the position, it's undervalued, excellent company with a leadership position. Look at the cash it throws off. In a bad week, it throws off 0.6%, which is more than 31% a year. A good week, it's 0.9%, which is close to 50% a year. So this is the kind of stock you want as a core position. And so let me review. You've seen this many times, but I got to repeat myself. I use 6 filters to say why open a position, why stay in a position, why close a position. So the trend is cloud computing. Yes, it's getting softer, but it's still a double-digit grower. EVs are a serious double-digit grower. It's a market leader compared to its competitors in both those. The stock is undervalued, as I just argued. $40 appears to be short-term support. You never know in this kind of market, but it looks like it is. The option chains are quite liquid, easy to trade. And the premiums are quite large, especially when you're rolling. And if you look at the training materials, I argue and say, and please listen to, when you're putting on a trade for the first time, you also have to look at the out weeks in case you want to roll. So you may have excellent premium in a front week this week when we go to trading tomorrow in our live session. Friday premiums may be great, but what are the premiums for the next week if we have to roll it? That's very important. And when do we close? As I said, these are what I said before. When fundamentals change, when the valuation metric that Wall Street uses changes, and that sounds complicated. It's not. Wall Street used to measure Netflix based on subscriber growth. It now appears it's measuring it on cash burn, cash flow, and profitability. So valuation metrics from a consensus of analysts and traders can change. Is there an exogenous event that says I don't want to go near anything? And in Income Madness, an old Income Madness stock, Kroger's, is tied up in a deal with Albertsons, and that's it. You don't know what's going to happen for the next 6 months to a year. The two CEOs appeared before the Senate last week. That's not our cup of tea. We're seem to be aggressive, but we're conservative income and cash generation service. When there's a compelling opportunity in the same sector, and in the case of Citigroup, I really think Bank of America, which I'm not here to talk about too much, but Bank of America has a lower dividend and a smaller stock buyback program than any money center bank. And therefore, those are a potential upside catalyst independent of performance of the sector of the bank. So it is the money centers, those 5 banks, it's the most undervalued. And you may not like to hear this. I know people, I can tell from my emails, they go, I can't take it anymore. I'm leaving because I just looking at red. That's not a reason to close a position. When you pay 60 for a stock and it's 40, you're saying, oh, I got to close it and use that $60 elsewhere. No, it's not 60, it's 40. So the way to evaluate shedding is if there's another opportunity, it's not what you paid for it. It's not what your cost basis is. It's what's the value in the open market. So trading this week, we trade live tomorrow. We've been trading more and more. We've opened up new positions. Probably 3 of the last 4 weeks, we've opened up new positions via alert as well. I want to piggyback onto strong retail sales data. And you go, what do you mean strong? There are some places that are struggling. There's been a decided temporary fourth quarter post-pandemic inflation. I'm going to a store. So people are shopping in brick and mortar stores more than they had in the last 2 or 3 years, and pulling back monies from online. Something to be aware of. And that's why all retailers, you walk into it, you go to a mall, which I do every weekend now in the fourth quarter or during the week. There's a Target in a mall near my home right next to a Bed Bath & Beyond. The parking lot in front of Target is full. You got to walk 50 yards to get to the entrance, 75 yards. Just go over 25 yards in another direction, and there's 12 cars in front of Bed Bath & Beyond. So there are winners and losers in retail. We're going to continue to trade a variety of stocks, names, and sectors. We've traded more than 30 different stocks to date this year, which is normal. It's usually between 30 and 40. If you're in the master's program, between the two, we've traded over 80. And we're going to focus the next few weeks on retail, downstream oil refiners, and chips. And that doesn't mean we'll be trading them for a year, but it does mean we'll be moving in and out. And we'll continue to sell puts, but over time, I always prefer owning shares and selling calls on something that's fundamentally undervalued. The issue from a publishing point of view is most members prefer to sell puts. One last comment about trading, and there's no slide to this effect, is it's December. And things start to get real light. Christmas is on a weekend. And excuse me. So you're going to see, from my perspective, and you'll see fewer recommendations starting not next week, but the week after. And we'll be rolling. We never trade between Christmas and New Year's, and it's Sunday to Sunday this year, which is quite convenient. And we'll be rolling into the next year if we roll positions. So just please be aware of that. On the other hand, December is an interesting month, and you're probably going to have a lot of chop, which actually is to our benefit. So I'm looking forward to it. And last point is, if you haven't heard about it, got an email, which I find impossible to believe, we start Income Madness tomorrow. 6 trading days, 6 days with one exception at Eastern time, noon. This Thursday, it will be 10 o'clock Eastern. And it ends before the Fed announcement next week. And our last one was the most successful we've ever had in that all 16 or 17 trades. We open and close very quickly, as you might guess. We closed literally on the last day of the live sessions, which has never happened. And we've done 35 or 38 or 32 of these. And since we started doing these, we've had one session that lost money. And it's possible we'd end up with 2, and they were both related to the end of last year and this year. The beginning of this year. We got hit in the first quarter. But they've all, and for those of you who knew, it's a very good learning experience as well. So think about it. With that, I'm going to turn it back to Emily for your questions.
Hey, and for anyone interested, I've posted a link to sign up for Income Madness in the chat box. Michael Terry says, regarding Marvel, can you briefly discuss how we would trade to capture appreciation as a primary objective with cash secondary?
What you would do, if you don't own it, you would buy shares at market and sell calls. You would sell calls. Let me see if I have something open. You would sell calls, 2 to 3 strikes out of the money. And so right now the stock is, you see how it's holding up by 40, it just doesn't even get close to 40. So right now it's at 44.85. So for this week, if you wanted to do cash, you'd get a 1.4%, you'd sell the 45. But if you're concerned about appreciation, you would bring it down to the 46 or the 46.50, but you want to check the chart. And so here's the 1-month chart. And you can see why I said with some confidence, we gapped down from 40 and immediately popped up. This is the 1-month chart. And so you're going to have problems breaking 46 at short term for a week. So you could go to 46 or 46.50 because we'll go back to the chains because of, remember I mentioned rolling. So let's say you sold the 46 this week and you picked up 0.9%, which is terrific. And it's still 46. Okay. And that's $1.50 more out of the money. Go to next week. So here we have 41 cents. If you go to next week for the 46, you have $1, whatever, and $1.05. And you could roll up. The point being, if you take a look at this and the stock starts to run, you've collected 40 something cents. So let's make believe you just wanted to capture appreciation and cash was second. You could roll up to the 48.50. I mean, this is the kind of thing you do before you put a position on. So what the chains are telling you is you have an enormous opportunity to roll a call forward and capture appreciation without spending cash.
Okay, Michael, Steve says, how do you view Moderna's performance going forward over the next 3 to 6 months, the stock performance?
It's always hard to say with something that, and Moderna, folks, is a income master's position where, since I'm an honest fellow, we started in the 400s and the stock was down in the 150s, 130s. We had a 20-cent profit on the position and I rolled it another week and the stock went down $30. I got greedy, which I'm not going to do again. It's going to be a bad COVID winter in the United States. It already is starting between the flu, RSV, respiratory syndrome, and COVID. Hospitalizations are going up. You're beginning to see booster rates go up. Okay. The big potential catalyst for Moderna is they have cut a deal with China, but the Chinese regulatory authority, with the Chinese healthcare, that for 100 million doses or 200 million doses or something like that. But the Chinese authorities have not approved any Western vaccines. And the people don't know. Well, that's not in the stock price. That's a potential, and that's a $50 to $100 pop in the stock. Any kid dies of a Moderna vaccine while getting the injection in his arm, the stock will go, God forbid, to 125. It's that kind of stock. I see the stock trading without any catalyst from between, I think it's been elevated from a 125 support level to maybe about 150. So you have, I think, about a 150 to a 190 to 195 cap in the first quarter, depending on earnings. Now, that seems it's that kind of stock. Here's the chart. This is the 6-month chart where you're down at 120 and you're up at almost 200. From a fundamental point of view, this is one of the cheapest companies on the planet. It's being traded like a startup biotech. It's been around for a very long time, and it has $20 billion in cash flow. So, and it has a very, very large early to mid stage, not final stage pipeline. In terms of cancer vaccines, in terms of other maladies, vaccines, and so forth and so on. So I like the company very, very much. I traded a lot in my own portfolio. But I do think they'll have earnings come out. Some will like it, some will, I think, at the end of January. I see 150 to 200, pretty broad, but a nice trading range to trade. You can sell silly puts, stocks at 177. For this week, you can get 0.5% by selling something $18 out of the money. Why don't you think about that? So it's an ideal trading stock. Now, for those of you in the only in options income blueprint, we don't trade it here because it's more than $100 a share. That's sort of an artificial limit I put on. On the other hand, we trade Pfizer. And Pfizer in its own ways has more of upside on a percentage basis than Moderna. Pfizer's an $85 stock, posing as a $45 stock or a $49 stock. And its leadership position is unassailable in the vaccine market in Europe because it's partnered with a German company, BioNTech, and so forth and so on. So we're going to continue to trade Pfizer. It has a tremendous pipeline. It's a $100 billion company. And it also has Paxlovid, which is a very effective COVID treatment in terms of preventing serious illness.
Okay, Richard says, how much capital should we have for Income Madness starting tomorrow for trading one contract? And what types of tactics will you be using?
I only sell puts and spreads. We do puts and we do bull put spreads in Income Madness. The artificial constraint is $50,000 in capital, one contract.
Generally 50 to 100.
Yeah, but the most we've gone over in the last 2 years is, I think, 61,000 in committed capital. Last was very unusual. The last Income Madness, we got our 1% return. We got more, got close to 2, excuse me. If we traded 2 contracts, because Emily, you can correct me, I think it was $26,000 to $28,000 in capital was the most we ever had out at one time if you did one contract. I can't promise it'll be that low this time. It was a little unusual. So we never really have gone past 60, but to Emily's point, you never know.
All right, Brent says, if I'm not in Marvel, are you recommending buying the stock and selling a covered call? We do currently have a net debit on the position, so we'll be putting out a new recommendation, either selling a put or doing a buy right this week. So if you'd like to wait for that so you can trade along with us, you can. I don't know if you're just asking generally about Michael's opinion on it, though.
To the answer, first of all, thank you, Emily, because Emily's right. We'll be putting out a position as early as tomorrow. And I'm inclined to go with the flow of the membership and sell a put. But if you wanted to do a buy right, what you would do is, of course, you buy the shares at market, and you saw the chains. You have to lay out a strategy and a goal for yourself. What is your goal in terms of appreciation, and what is your goal in terms of cash? And when you have those two goals aligned, you figure out, well, I need this much cash, so I'm going to sell puts. And And because I'm going to follow Michael's recommendations and we're getting 0.5 to 0.9% a week, or you're going to say, I got time. I don't need to pull cash out. So I'm going to buy the shares and I'm going to sell calls out of the money and generate cash lower than if we sold puts and try to capture appreciation because I want to stay in this for a few months. So you have to decide what you want to do. We'll probably be trading puts at least now. If the stock punches 45 and stays there for a week or two, then I might buy it. Right now, I'm leaning against a buy right because if we can't punch 45 and there's any kind of a kerfuffle in the market, you could see it drift down to the $42 or $41 level. And it's easier emotionally for many people, and I'm not making fun of anyone, to manage rolling puts like this than to own shares and sell calls, even though the math is the same. So right now, 80% chance it's a put strategy. But if you wanted to do calls, I can walk you through things. Just shoot me an email. And I always do this. I'll walk people through their different choices and goals and stuff like that.
Okay, a few people are asking about Target, your thoughts on it, and the reason behind the sell-off today.
Most retail's getting hit, but let's take a look. So the XRT, which is the retail ETF that I track, is down almost 2%. And Target's down 4%. So let's take a look over here. It's very possible that weekend sales data came out. I haven't looked this morning, so I was preparing for this, in Target's an income master's position. There's nothing here. I didn't get any alerts on my phone about Target. It could be an analyst recommendation that let's look at the other big box stores. No, Walmart's not down that much. It's probably a specific something that we're not privy to yet. We've had a rough go with Target. We've rolled the underlying Leap. I still think it's significantly better managed than the other big box stores. And they've just been struggling. And the thing is, they've admitted it in that they have two issues. One, of course, is still the mismatch of inventory to consumer demand, which is the heart of all retailing problems when there are problems. They were the first to jump on paying people extra during the pandemic, and now they have a cost structure. They start to pull some of that back, and they start to lose people. And they're wrestling with how do they keep the stores properly, people properly employed, especially through Christmas. But they've been upfront about it, which is one of the reasons I continue as a long-term hold that we sell calls against. And the capital that we have tied up in the underlying Leap is small compared to the amount of cash rate of return that we get. So I'm still going to continue to trade it. I will take a look, and maybe we talk about it during the question and answer period in Income Madness tomorrow. I'll take a look and see if there's something I can find out what's going on today.
All right, Michael, Tony says in the past you've traded Micron Technology. Are you still positive on it? And what is your preference for Marvell versus Micron?
Micron. And Micron is an existing position in Income Madness and Income Masters, and I don't trade them if I have a stock open in one place, in one service, I don't open it in the other. Micron would be one of my 2 or 3 top stocks for 2023. Huge premiums. For those of you who are familiar with the company, it's really the only pure play on memory. It is the technology leader in what is called SSDI, or solid state memory, and excellent management, extremely undervalued. And it's very bouncy because there'll be a report about average selling prices for memory chips. And if those go down, the traders, and some of this is algorithmic, by the way, there is some trading that takes place that a computer server at a trading firm reads a headline and automatically trades something. Micron typically commands higher average selling prices for its flash memory, and I think it's worth 2 to 3 times as a stock over the next 3 years what it's worth now, and it has huge premiums. It's, as I said, it's an open position in Income Masters, and that's why we don't trade it here. We'll wrap up that position actually sooner rather than later, and when we do, I'll be moving it between the 2 services. They're very different companies. Micron is a pure commodity chip play and will trade based on data about memory chip prices. Marvell went down with the sector, and it went down after the bubblicious trading on EV suppliers. So very, very different companies.
All right, Michael, Paula says, what about Western Digital?
It's a hybrid. It's a memory company and a hard disk drive company. And given what's been going on with demand in the personal computer market and in the server market, hard drives are commodities as well. And I've avoided it. It's very easy to trade, by the way. And it usually has excellent premiums. But if you take a look at the chart, you'll understand it's gone down almost as much as Marvell, perhaps more. This is the 1-year chart. You're up here at 70. It's down about 50%, which is Marvell's down 49 in a year. And that reflects the chip sector and concerns about growth in China and all that sort of stuff. I've traded it. I think we traded it earlier in the year, and I will trade it again in 2023, but not every week or not every month. It'll be opportunistic based on the charts, because the underlying business model makes it more difficult for me to follow and get a handle on where I think they're going because of that mixed manufacturing of hard drives and memory.
Okay, that's all we have for questions right now.
I'd like to thank you all. Please, if you're new, please be aggressive in using your email with me. I answer them all. I like them. I enjoy them. I get an insight into what members are thinking. And I'll see you all in live trading tomorrow.
Great. Thanks, Michael. Thanks, everyone, for joining us. We have recorded this session and we'll be posting it to the member website as well as sending it out to you in your weekly newsletter. Please join us for live trading tomorrow at 11 a.m. Eastern. And if you'd like to join us for Income Madness, we'll be trading next week, starting tomorrow and trading through the 13th with live trading every day. Click on the link in the chat box to sign up for that, or you can always reach us at support@tradersreserve.com. Thanks and have a good day trading.